We're committed to discussing, as you can see, with a sense of intellectual exploration, but even maybe a sense of fun today, on social impact. It's been a decade or so since the coining of the phrase, since the start of this industry. You are now committed to this field with your newish venture.
Yes.
Can you tell us just a little bit about what got you interested in this space? Because you were a titan of finance. You held senior jobs in traditional finance. You were not known as a social impact person through your career, typically. Can you tell us what got you interested? Indeed, is it fair to say you were initially skeptical over the years?
Oh, I was skeptical. I was dismissive. I did not believe that you could earn competitive returns while having a social impact. I thought, let's keep those two things separate. Let's really focus on the competitive risk-adjusted returns in our investments and give the money away later. I turned down meetings with impact investors.
Very Milton Friedman perspective.
Yeah, and I turned down meetings with impact investors. If you had worked your way into my office when I was running Merrill or Smith Barney and said, I'm here to talk about social impact, I would have said, you're a granola eater, tree hugger. Right. So I was all the way with old Wall Street.
And was your notion that it's just sort of a frivolous waste of time or something else?
Well, I think it was a bit of you can do one thing well, right? It's hard to walk and chew gum at the same time. You can do one thing well. And I believed that the research I saw, being a research analyst by training and now a recovering research analyst, I believed the research that I saw at the time showed that you had to give up returns, and so I sort of stuck there. But things changed over time, and I have become passionate about gender lens investing, and have become passionate about the belief that when we invest with an eye towards getting more money to women or more money in senior leadership teams, that the businesses do better, our economy does better, our society does better, our families do better, that there is a positive ripple effect that occurs that is meaningful and long-lasting. And the way I got there, quite honestly, was the financial crisis. So, as you and I were talking about yesterday, I've had the privilege of having really an amazing set of jobs on Wall Street. I, back in the day, was a research analyst covering Wall Street. I was a CFO of a large bank. I ran large businesses, both at Citi and Bank of America. And so I had a front seat row on the growth of Wall Street and then the financial crisis. And so as we were ending the financial crisis and I was giving consideration to joining the Obama administration, I found myself making trips to the Hill, making trips to the White House, and being asked, with this set of experiences, what were some of the causes of the financial crisis that we're not talking about?
What was the most striking thing that struck you?
Well, look, and everybody, there was too much leverage, and there was too much risk, and there was a blah, 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 everything we knew. But what I saw when I was at those tables that is really still not particularly talked about was groupthink. And that these were individuals around this table who were super smart. I mean, these folks don't come any smarter, but who had a set of experiences that paralleled each other, right? They started in the Salomon Brothers trading class of 1984, and they went through the Russian crisis together, and they went through the crash of '87 together, and they went through...
They all played liar's poker and so on.
Oh, everybody played liar's pokers, right. And so... when the conversations would happen about the crisis of '07 and '08, it was, don't you remember when? Yes, I remember when, and finishing each other's sentences. And so what was not available at the table was the breadth of experience and the breadth of perspectives that one gets from, dramatic pause, diversity. Cognitive diversity, which in turn comes from diversity of all kinds. So at that stage, I started to say, we just didn't have enough different points of view in the room, and nobody's talking about it. And then I sort of backed up and began to look at the research that says when you have greater, in this case, gender diversity, you get higher returns on equity, lower risk, greater innovation, greater client engagement, greater employee engagement. The power of diversity is so substantial that more diverse teams outperform smarter teams. And by the way, I get it. I'm an analyst, right? Maybe it's causation, maybe it's correlation, maybe it's coincidence, but it's a hell of a coincidence that these things occur, given all the research that's out there. And then I would argue, just to sort of, test the idea in our minds of, does this make sense? I mean, is there anyone in this room who believes that if the trading floors, which are 90% gentlemen, pretty close to 90% white gentlemen, were 50% women, 40% people of color, that the financial crisis would have been worse? And of course, the answer, no, there's not a person in this room who thinks it would have been. And what backs it up is that homogenous teams tend to overtrust each other. There is research that shows that guys, and by the way, I love middle-aged white guys. I've been married to a couple of them. I think y'all are like these incredible, my husband is the whitest man you will ever meet. He's practically transparent. He's so white. So this is not about excluding any group, it's about including another, but there's research that men tend to show off for each other in competitive situations. I think some of us can imagine that happening. And there's research that shows that there is a correlation between testosterone levels and poor risk-taking.
Right.
Right? And when you look at all this together, it becomes pretty compelling. And I'll add one final thing.
Sure.
Who do you think earned money in the 10 years before the financial crisis? And into the financial crisis, Sanford Bernstein, a company I used to work at, research, mid-level sort of company, or Merrill Lynch. Of course, the answer is Sanford Bernstein, right? We earned much less in the run-up, but we didn't lose everything in the downturn.
So with this set of insights, empirical, but also drawing on some of the academic research that I think a lot of us will be familiar with, you decided to make a bet. You decided to start a company. So tell us a little bit about your gender lens investing concept.
Yeah.
And what have you found out by doing it?
Well, I'd say a couple things. So I actually have a few different bets that have been placed.
Okay.
One of them is a quantitatively managed mutual fund, the Pax Elevate Global Women's Leadership Fund, that invests in the top-rated companies for advancing women as determined by the percent of the board that are women, the percent of leadership team that are women. And these tend to, when you look at these, they're not, macrame companies. These are big, successful, strong companies, be it, a Salesforce in there, a Morningstar, et cetera, companies that for whom diversity is a key part of their operating objectives. And that, over the past 4 years, has been outperforming the MSCI World by about 80 basis points a year. I also went to...
Actually, before you go to the next example, I want to channel our professor with the snuggly sweater from the debate and ask about benchmarks and metrics. You're looking to invest in companies that are over-indexing on female representation and leadership, it sounds like, in that particular example. Are you, what are the right comparison points for that? Is it the broader index? Is it the same companies before they had the additional women in leadership? Are there different ways of looking at this that might reveal different interesting things?
So we start with the MSCI World.
Okay.
And from there, it's just the facts, right? Which boards have got the highest percent that are women, leadership team that are women. There's a smaller weight for female CEO, female CFO, and whether they sign the women's empowerment principles. But it's a just the facts sort of look, and what we're really trying to drive is, one, capital to these companies that are doing it right, and number two, of course, returns. And what we didn't do, and I feel sort of strongly about this, what we didn't do is, well, do they have a women's initiative? Well, what's their child care program? Well, I've sort of come to the point of view that none of that stuff works. And why? Because we've all been doing that for decades, and we're not moving the needle. And so let's just invest in the companies that have actually done it, as opposed to try to get to all the factors that in theory will lead to greater.
And when you say it doesn't work, you're not saying it doesn't work, and providing a creche obviously helps that company's mothers with children, let's say, or families with children. You're saying it doesn't necessarily work in increasing returns, which is what you're keeping a financial focus.
And then, the business that I'm spending the vast majority of my time on right now is a business called Ellevest. Ellevest is an investing platform for women. You may say, as I did, women don't need their own investing platform. That's a crazy idea. Money is gender neutral, and that's sexist. And I
would never say that, by the way.
I did. I was like, that, and Junior, that's so dumb. You know, what are we going to do? Like, oh, look at us women investing together. Except when you look at having a social impact, women today keep 71 cents out of every dollar in cash. Men keep tens of cents less. Therefore, before even talking about the gender pay gap, there's a gender investing gap that wasn't being spoken about a few years ago. That cost, probably not the women in this room, but the women walking around New York today, hundreds of thousands, some of them $1 million+ over the course of their lives, because they're being too conservative in their investments. We, as an industry, probably not surprising when 86% of financial advisors are male, and 90% of traders are male, and 90% of mutual fund managers are male, and 95% of hedge fund managers are male, our reaction to this has been, you women need to change. You need more financial education. You are too risk averse. You need to do something different. And Ellevest was really the first one that said, what if instead of just thinking about this as a marketing campaign where we try to get women to change, which hasn't worked for decades, how about we actually look at the underlying product? And we change the underlying product. And then in marketing, we engage them about topics they're most interested in.
So I want to alert the audience. I'm going to come to you for questions. We have a little time for that. Collect your thoughts, please, to get one or two good questions for Sallie. But tell us, in brief, what's different about your product that you've come up with that doesn't pander to women in that way, but rather acknowledges what is a market gap?
So we've interviewed in the course of founding Ellevest, by the way, with the support of Morningstar, who's here. When I went around with this idea, Morningstar immediately said, there's something, we don't know if you can solve it, Sallie, but there's a big gap we see in the marketplace. And they stepped up and supplied us with our seed funding and have been incredibly supportive ever since. But take a guess, we have interviewed hundreds of women over thousands of hours, maybe thousands of women now. Do you want to guess the number of women when we said, what is your goal in investing, who said to us, outperforming the market?
All of them, I hope.
One.
Oh, really? Okay.
So it wasn't all of them said it.
All right.
It was one. And so we have an industry that's been about alpha and outperformance and picking the right manager in large cap value versus small cap growth, and watching CNBC, and women have said not interested.
Okay.
Right? And in fact, if you look at CNBC, we all love CNBC, but their viewership is what, 85%, some of the shows 90% men. Barron's, they tell me their readership is 90% men. And in fact, every symbol we see when it comes to investing is masculine, that beating the market, that outperforming. The industry symbol is a bull, right? It's a phallic symbol. Not a woman says, I just love that bull. My two brands that I love the most are Tory Burch and the bull, right? It just screams, stay away. Guess what the other thing is that women want?
What?
86% of our women are looking for impact investing. Guess what percent of their financial advisors have talked to them about it before they come to Ellevest? A single-digit percent. And guess what percent of those financial advisors have talked to them about it in a positive way? A lower single-digit percent. And so we began to identify these gaping holes in the market that we were just looking past because our industry lacks diversity.
Fantastic. Let's see. Hands up, a question. Someone who hasn't asked a question before. You have not. Okay, let's get a microphone to this gentleman here, and I'll try to get in a couple of questions in the little time we have. Please identify yourself as well, sir, as always.
Sure. Michael Schlein from Axion Impact Investing for Financial Inclusion. Sallie, I've had the honor of seeing your trading floor. By far, it's the most diverse trading floor I've ever seen, but probably in the world. Two questions. One is, how do you recruit? How do you find talent? And second, how's the performance?
Yeah. So thank you for that. And our business overall today is just over half female. Our leadership team is 2/3 female. We are 40% people of color at our company, so representing the environment around us. Our engineering team is 50% female, which is pretty unheard of. And we think those things have led us in having an inclusive environment where people can really be their true selves, have led us to being number 14 this year on LinkedIn's most sought after startups, number 2 in New York City. And the word is sort of out. If you're an individual who's interested in fin or tech, and you don't fit the mold that you see at some of the other places, go on over to Ellevest. And the way we did it is we did it from the very beginning. This wasn't look, there are 15 of us who now look the same, so now let's try to change it. It was from the very first hires, and it wasn't without some fights. And so, one example I was telling Kunal backstage was one of our beginning hires, an individual was choosing between someone who looked just like her, sort of a blondish, blue-eyed Caucasian female, and an individual of color who was gender fluid with the whole mohawk and the tattoos and the whole 9 yards. And when I went and asked, well, who were you leaning to for hiring? She said, I'm leaning to the individual who's just like me. She didn't say those words. And I remember my co-founder and I getting into a fight, as in perspiration down my side, you feel it trickling, fight over the phone about whether I was going to override this individual and say, you can't hire the person you want to hire, because if you think it's 48%, for the individual who's different and 52% for the individual like you, you're wrong. It's 70% for that individual because you're not used to overcoming your biases and your expectations in order to hire this individual who's different. And my co-founder said, we can't overrule this manager. We want to build a meritocracy, right? We want to let our managers manage, and if this individual then fails, it's going to be your fault, not hers. She's not going to put the time into it. And I finally said, look, I'm the friggin' CEO. And I've worked for decades in an industry that's a meritocracy. Wall Street, right? That just happens to be the least diverse industry around.
Right.
And by the way, their returns suck, right? And with Wall Street, the mistake we always make is we look at these firms' returns during an upcycle. We fail to look at them, or the press fails to talk about them through the course of a cycle.
Sure.
They are fine when things are good, and for the last few cycles, disastrous when things are bad.
Is it too early to ask about returns, as the gentleman did for your venture?
The challenge with the returns is that we, using the power of technology, provide individualized investment portfolios. Not just yours is different from yours based on your earnings power, based on the goal you want to achieve, based on your, we track out, what you should earn based on where you are in the country, where you are in your career. But it's also different, each portfolio for each goal you have. So your home goal, we help you quantify it and put a portfolio towards it, is different from your home goal, is different from your retirement goal, is different from whatever. So this concept of are we outperforming or underperforming, we've thrown away. We don't even compare our performance to one of the broader market indices. It's, are you on track to reach your goal, which is all women care about. They're not about outperforming, as mentioned. It's all about, can I buy that house when I want it? Can I live the 6 to 8 years longer than my spouse when he's gone at 90% of my pre-retirement income? That's what they want.
Well, I wish you luck, because people will judge your performance, I imagine, because the world still, like our professor on stage during the debate, will demand some metrics. But maybe you can have testimonials from the people who are your clients.
Well, we're not allowed to do testimonials because we're an RIA.
Is that right?
But you can you can look at the business growth.
So it's an act of faith, I guess, right?
No, you look at the business growth.
Yeah.
Right? So how are we doing? And think about where we started, right? Where we started was, hi, Susie. We're Ellevest. You've never heard of us before. We have no track record. We're online, so you can't talk to anybody. We're going to invest in a fully goals-based way, which, by the way, when you show your dad, who's who you go to for advice, he's going to say it's dumb. We're going to provide you with impacting options, which when you go to your dad or your financial advisor is going to say it's dumb. But, go ahead and put all that aside, and would you send us money online? Oh, by the way, and your money's in cash, and so it's safe, and we want you to invest it so you could lose everything. Okay? And guess what? When you compare us, so I think it's probably the hardest thing you could try to do in financial services. We are just 2 years out of the chute, and when you compare us to the growth of the first generation of digital advisors, Wealthfront, Betterment, Personal Capital, Sig Fig, Acorns, et cetera, we were the fastest to 100 million of assets under management, 200 million, and now $250 million. And so what we've done is, in disrupting the industry, hit on a need that was able to overcome, what would be, whoa,
right.
Why would I send you my money?
Okay, I see that. I see a hand there. Let's get a microphone quickly to the lady. We're well over time, but let's have the question and a quick answer as well.
Hi, Sallie. I'm Aisha D'Souza, African Leadership University. We are high-quality education and job training at scale in Africa. I'm actually an Ellevest customer. What happens?
Is that a plant? Is that what's going on here?
No.
All right,
no,
okay.
Not at all.
Remember, no testimonials allowed. Yes.
Nope. What happens when you're off track? What do you guys do to get someone back on track?
Yeah, it's a great question. First of all, by the way, we do invite gentlemen to become clients too. I just want you to know we kill you sooner.
Good to know. All right.
When we track out what you need for retirement, we kill you sooner and we have you earn more money. Which is just what life is.
Good. I'm glad you're
and so as
brutally honest about these things.
As mentioned, we tell you every day you're on track or off track to reach your goal. On track or off track to reach your goal. What does that mean? You will reach your goal or better in 70% of markets. If something goes wrong, the market corrects more than we expected in our models. You didn't make your monthly deposit. All the range of things that can happen. You didn't put in the one-time deposit, et cetera, et cetera. You can see that you're off track, and we'll send you an email and say, you're off track. In order to get back on track, deposit another $100 once, every 2 weeks, deposit another $1,000 today, retire 2 months later. What we've done here is we've taken that very scary moment, like what we saw October, November, December, of, oh shoot, the market's down, should I freak out, to something that is understandable and relatable, right? Okay, the market's down a lot, but if I just deposit another $100 for the next 6 months, I'm back on track. What we found, so the bear case against Ellevest was, well, they grew those assets in a good market, but when the market's bad, they're going to decline substantially. Our attrition rate during those months was less than 4% annualized, and we had record inflows. And so by changing it from jargon, right, and just a scary graph to this is what it means for you, we think we're building something special. Now, one thing, and I know we're over time, one thing that I do want to make sure to add is some of you are looking at this like, well, what impact is this? Like what? Can we just get back to the environment? Because I don't know what's going on up there. And part of how I think about Ellevest is the positive ripple effect of what we're doing, which is by there's nothing bad that happens when you get more money in the hands of women. And by helping women grow their wealth, it's good for, the research tells us, good for their next generation. It's good for their family. It's obviously good for the economy. We see all the research about when women are more powerful, how it sort of takes down anger levels, smooths things out in our society. And the combination of getting more women to invest and getting more women to invest for impact, and again, much of which is gender lens, we're seeing this amazing ripple effect of women investing in women investing in women, which we believe, we're already beginning to see, though we're still small, the very powerful impact it can have by having women own money. Because the truth is, we grew up, in a sort of puritanical society where sex was off limits to talk about, no longer, but money for women has been off limits to talk about. And breaking through that and having women, own their financial futures is a very powerful catalyst for this country.